Hello, this is Maila the Hybrid. Welcome again, and today we're going to take a look on variable production overhead variances. What are variable production overheads? These are just indirect costs that are variable and they are related to production. So how do you compute their variances? First of all, to know how to compute the variances, you just have to know how to compute total variable overhead cost. And how do we do that? Variable overhead cost equals to variable overhead absorption rate times hours of labor worked. Actually, it should not be necessarily that hours worked could be hours paid because just the variable overhead cost, but also you should also understand one thing. By variable overhead absorption rate, we just take overheads, variable overheads divided by the activity level specified. It could be machine hours, not necessarily labor hours, but this is a common practice. We usually use labor hours. That's why I use labor hours. So we'll have two variances, one based on the rate and the other based on the hours worked. That's why we say variance on labor is subdivided into expenditure and efficiency variances, and we'll see this in a very precise pro forma that we use for all other variances. For example, variances on material as well as variances on labor. And we'll see the definitions on the fly. So, as usual, overheads represent cost, and so if actual results are poor compared to budgeted results, the variances will be adverse. That means if I incur much higher cost than what I expected, then the variances would be adverse and the reverse. So, let me take you through the question. Variable production overhead cost of product Q has a standard cost of 2.5 hours per unit at $1.2 per hour. This is the information given, and we are told that during the period, 1,100 units of product Q were produced, and the labor hours worked were 2,800 hours, while 3,200 hours were paid for, giving idle time of 400 hours. The variable overhead cost was 2,900. Then compute the following: variable production overhead expenditure variance, variable production overhead efficiency variance, as well as the variable overhead total variance. So let's see the pro forma. What do you do when you encounter something like this? If you haven't subscribed, subscribe for regular updates. Alright? So I explained this in a very precise pro forma as you see here. We have the first row, hours, the second row is the rate, and the third row will be the multiplication of hours and rate that will give us the variable overheads in total. So at first, we start with actual hours and actual rate, the multiplication of which would give us the actual variable overhead incurred, and then we have actual hours and standard rate, and then this is SA, is standard hours for actual output. Standard hours for actual output, we will see how to compute it, then at standard rate. So you start filling up your information. We are given actual hours as 2,800. Note that when computing overheads, use actual hours worked, not actual hours paid for. If you go back and look, you'll note this. Here, we are given 2,800 hours. These were hours worked, but 3,200 hours were paid for. So use hours worked. So use 2,800. Now back to our solution. So actual hours worked to 1,800. We'll repeat it there. And then you will need standard hours for actual output. Now how do you obtain it? SA means standard hours for actual output. So you obtain it by multiplying standard hours by actual output. How much of standard hours were we given? You go back to the question and locate it. Here we are. We are told that standard cost was 2.5 hours per unit. So a single unit was expected to use 2.5 hours. And actual output was actually how much was it? We are given here 1,100 units. So just multiply that. So your back here, you just take 2.5 hours, you multiply by 1,100 units, and you obtain 2,750 hours. You plug it in there. After that, you proceed with other information. we are given the actual overheads incurred is 2,900 from the question. Here, the variable overhead cost was 2,900 as you see here. And then if you look, we are given the standard rate. Because this was the standard cost, so this is the standard rate, $1.2 per hour. Actually, this is the variable overhead absorption rate. So you go back to your question and plug it in. Standard rate and standard rate again. After that, you multiply 2,800 and 1.2, you obtain 3,360. 2,750 and 1.2, you obtain 3,300. After that, you are done. All you have to compute the differences. No, you just have to note one thing here. For the first two columns, this one and this one, what makes the difference here is the rate, because there is actual rate and this is standard rate. So the variance here is called the variable overhead expenditure variance. It arises due to the difference between actual absorption rate and the standard absorption rate. And here, the difference is due to top here. This is actual hours worked, while this is standard hours for actual output. And so we call it variable overhead efficiency variances because it compares hours expected to be used and hours actually used. So you take the difference between 2,900 and 3,360 and you obtain 460. Now, to know whether the variance is favorable or adverse, you just have to compare. If you look at here, we have 2,900 and here we have 3,360. That means that because here we have 2,800 and here 2,800, it only goes to show you that this actual rate will be less than 1.2. So I estimated to use 1.2 to incur the cost of to absorb overhead at the cost of $1.2 per hour, but I ended up incurring less, and so the variance will be favorable. And according to this pro forma, if the left side is less than the right hand side, then the variance will be favorable for cost variances. And then we come here, the difference between 3,360 and 3,300, you obtain $60 adverse. And this will be adverse. Adverse in that we expected to use 2,750 hours, but we ended up using more. So we use more. For the same output, you use more, and so the variance would be adverse. And then we got the last step. Variable overhead total variance. I'm sorry, here it was variable overhead total variance, not labor. It's variable overhead total variance. So just add up here 460 plus 60. This is favorable, this is adverse, so they'll be antagonistic to each other, so you have to subtract. So I'll end up having $400 favorable. And this is how we do the variable overhead variances. Now note, labor hours paid for and worked for. Variable overhead production variances are generally assumed to be incurred when labor is actually working. That's an assumption. And therefore, hours worked for will be used and strictly not hours paid for unless required otherwise. For labor variances, you can refer to the other video. You can learn that actual hours paid for and worked for can both be used in computing labor variances, for example, when computing idle time variances. So in case just one of them is given, you can just assume that they are equal. Now, reasons for variable production overhead expenditure variances. First of all, more economical service utilization. We are just talking about expenditure variances. So if you actually you expected to use more, to spend more, and ended up spending less, that could give you a favorable variable production overhead variance. But you can say a rise in cost of services. Yes, rise in cost of services. Let's say the variable overhead production overhead rate has risen, so you have ended up incurring more than what you expected. This could give you an adverse variable production overhead variance. Then let's see the reason for variable production overhead efficiency variances. Note that efficiency variances arises due to difference in hours, expected hours, and actual hours. So, first of all, we can check on the level of efficiency of labor puts on. If labor puts more efficiency than what we expected, then the variance will be favorable because much less hours will be used, contrary to what was expected. Then you can check on quality of materials. Sometimes materials can affect the labor variances in that if you have poor quality of materials, that means labor will need more time to complete the work, and so this could lead to problems of adverse variances. So that's all. Subscribe for regular updates and you are